Hello everyone, my name is Elliot Gu. I'm co-founder of Capitalist Times Investment Research and Smart Bonds, and I wanted to jump on a quick video today to talk about what happened last week in markets. Obviously, it was a really ugly week for the equity market. In just 2 trading days, the S&P 500 was down more than 9%. And if we go back over the last 30 years, back to the early 90s, that's only happened on 8 other occasions. And when we look at the dates where that's happened, where we've seen a 2-day decline of that magnitude, it doesn't make for very pretty reading. Times like late 2008, during the height of the Great Recession and financial crisis, loom large. Now, while it was a very bad week for the stock market, it actually was a very good week, or a good week, for many corners of the bond market that we cover in the Smart Bonds service. Particularly in Smart Bonds, we look at bond ETFs, exchange-traded funds, tracking various niches of the bond market. Obviously, the government bond market did very well, particularly long maturity treasury bonds and ETFs that track that segment of the market. That acted as very much of a haven for investors in the bloodbath last week for the stock market. But we also saw some sectors of the high-grade corporate bond market do very well, and some sectors of the international bond market do quite well. And in fact, I was just this last weekend reviewing the performance of the Smart Bonds model portfolios so far year to date, and the bond portfolios are up this year. Despite all the turmoil we've seen in the broader market. I think the S&P 500 is down around 13.5 or 13.6% year to date through the close on April 4th, including dividends. So the bond market has provided something of a safe haven amid all these market storms. But what I really wanted to talk about today is what I think is really the ultimate issue that's troubling the market, and also how we're responding to it in the Smart Bond service, and where I think there actually are quite a lot of opportunities for upside this year. In fact, some of these areas could do even better if the stock market continues to sell off later this year, or we get a recession in the US. And that brings me back around to the key point about the markets and economy. I mean, you'll have a lot of people tell you that this is all about tariffs, and obviously tariffs, the tariff announcement was what sparked the big 2-day sell-off in the stock market late last week. But I think the bigger issue is the health of the US and global economy. And specifically, whether the tariffs that are being imposed, other things that are happening right now, such as cutbacks in government spending, could ultimately spark a recession in the United States, say over the next year. Historically, the S&P 500 enters a severe bear market only within a year or so of a recession. Not always true. We didn't get a recession in 2022, stock market was down more than 20%, but most cases in the post-war era, in order to get that scale of a stock market decline, 25, 30%, you have to see a recession. So the big question is, are we headed for a recession? And I think the key point to understand here is there's a fundamental complacency out there in markets, I think. And a lot of it has to do with the soft landing that we experienced in the United States back in 2022. There are really 2 flavors of economic data up there, and I do have a few charts I'm going to throw up here on your screen as I talk through this. But and these are all from the update I sent out to Smart Bonds readers this weekend. So, but there are 2 flavors of economic data out there. There's soft economic data and there's hard economic data, right? So soft economic data is things like surveys. So any economic data series that's based on a survey. So consumer confidence. University of Michigan, for example, consumer confidence. It's based on a survey. Also, the one I watch very closely is the Institute for Supply Management Purchasing Managers Indices. These are based on a monthly survey of managers of major manufacturing companies or manufacturing companies in the United States. So this data is more volatile, right? There's a lot of noise in it. However, it also tends to be leading. So it tends to give you an earlier read on the health of the economy than hard data. Hard data is quantified, counting actual economic activity. Examples there include, for example, the Bureau of Labor Statistics employment report we got on Friday, right? Where we're actually counting the number of payrolls, the number of jobs created or lost in the US. And so typically the way it works in a cycle is you see a handoff. So first you see weakness in soft economic data, and then over time, months, sometimes several quarters, you'll see that pass over into actual weakness in the hard economic data. So the advantage of the soft data is it gives you an early read. The disadvantage is that if you only look at the soft data, you are going to get some false signals, some indications recession might be ahead, and then no recession comes forward. So there's advantages and disadvantages to both types. I do think soft economic data is extremely important because most of the time, and if you go back and look at every economic cycle since, say, 1945, right? If you look at the soft data, almost every recession, you see the weakness show up in the soft data first and then pass through to the hard data. There are few instances, like the late 90s being one and 2022 being the other one, also once back in the mid-60s, where the soft data kind of weakened, but it never really followed through into the hard data and we didn't get an actual recession. But it's comparatively rare. But what we saw in 2022 was we saw the soft economic data weaken, but it never passed through the hard data. What we're seeing now is we're seeing the soft data weaken, but it hasn't really showed up in the hard data yet. For example, Friday's employment report was pretty robust. More jobs created than the consensus on Wall Street expected. Unemployment rate was a little higher than expected, but if you look at the unrounded data, it wasn't much in it. So pretty strong jobs number, but the soft data has been weakening. And you even heard Jerome Powell, after the Fed meeting back on March 19th, say, you know, we haven't seen lately the soft data hand off to the hard data. And when I hear that, honestly, it really scares me because it means that there's a lot of people out there probably, including people at the Fed, who are saying, well, you know, until we see actual weakness in the hard economic data, you know, we can't trust it. We can't forecast a recession. The fact is, if you wait for weakness in the hard data, the recession is probably already underway. If not, it will be within a month or two. So let me show you what the soft data that I'm looking at right now is showing us. Now this is actually this is a chart showing a ratio based on the ISM report, which I said comes out every month. It's a survey data. And what I'm looking at, what you're looking at on your screen is the ISM new orders index divided by the ISM inventories index for manufacturing. So new orders is an index that shows the incoming pace of new orders for manufactured goods. So when this reading is above 50, it indicates an accelerating pace of new order activity. When it's below 50, it indicates a declining pace or a contracting pace of new orders. The inventories index is the same thing, but for manufacturers' inventories. When it's above 50, manufacturers' inventories are expanding. When it's below 50s, they're contracting. So if you think about the ratio there, if both indices were at 50, it would be at 1, right? But if new orders are relatively high relative to inventories, the ratio will be above 1. Now that is a very early warning signal that, or a very early signal in this case, when it's above 1, that the economy is strengthening. You know, think about it. If a manufacturer has an accelerating pace of new orders coming in, but also has very lean inventories, that's very good news for production activity and for economic activity. Now on the flip side, ratios below 1 indicate that the pace of new order activity is below the pace of inventories. That's terrible news, right? Because what it means is that the pace of new orders is declining or slowing, right? At the same time, you have inventories rising or contracting at a much slower pace. So in that situation, you can have a situation where you have excess inventories and slowing demand, and that's terrible news for economic activity. Now what you can see in this chart, I took this back to December 2019. We had a big decline in early 2020. That was around the COVID lockdown recession, and a very rapid recovery. And the reason we had that rapid recovery is all that fiscal and monetary stimulus that hit the economy during COVID lockdowns and caused the economy to reaccelerate, manufacturing activity to reaccelerate. Then we had a period of a little over a year there of very strong readings on this ratio. Then it began to weaken. Now in 2022, we actually got below 1. So we got to a weak level. We got down to about 0.85 was the low, just a little over 0.85 on this ratio. Now that is a level historically consistent with elevated risk of recession. That's why a lot of economists were out there talking about recession. That's why I was saying that there was high risk of recession back in 2022. Now we didn't end up getting a recession. The weakness in soft indicators like this did not, as I said, pass through to that hard data. And by 2023, early 2023, the recession scare was over because this ratio started to climb and reach levels back above 1 before the summer of 2023. Now, here we are once again, and in the month of March 2025, this ratio actually dropped below 0.85. So it actually dropped below the lows of 2022. This is a sign of severe and rapid weakness in the US economy. Now again, this is based on survey data, and surveys are inherently more noisy than counting the number of payrolls created. At the first whiff of trouble for the economy, most companies aren't going to go out and fire a bunch of people. They're usually going to wait some period of time before layoffs, right? To see whether it's a temporary soft patch or maybe the economy will reaccelerate. Now, the last thing you want to do is go out and fire a bunch of people, right? And then 6 months later, you have to hire them back, which is expensive both to lay people off and then to hire them. So that's just the mechanics of it. I think that a lot of people, for example, Jerome Powell, have mentioned the weakening in this data series and other soft data series like consumer confidence. And they're saying, well, yeah, but maybe it's like 2022 because we didn't see the pass off to the actual economy back then. That, as I said, is very dangerous. We didn't see it in 2022 in a big way anyway, a little bit, but not in a big way, not in a recessionary way. But we've seen it in almost every other cycle going through of the post-war era. In my mind, one example of a soft landing, or two, really there have been two soft landings in the last 40 years. One was back in the late 90s, one was in 2022. That doesn't negate the experience of all the recessions we've had over the similar time period that have been of that manner, where you have a weakening in the soft economic data followed by a weakening in the hard economic data. But that's not all. I want to talk a little bit about an area that I watch very closely across all of our services and across all of my work, but particularly as it pertains to the bond market, and that is credit spreads. Now, let me throw up a chart for you here. This is the Bank of America high yield options adjusted spread. Now, this is the spread in yield between Bank of America's high yield bond index, which is what we used to call junk bonds back in the late 80s and early 90s, now are somewhat, I guess, have a nicer title called high yield bonds. But these are companies. This is debt issued by companies, bonds issued by companies with below investment grade credit ratings. And what this index does is it compares the yield on those bonds to the yield on a treasury bond, a US government bond of equivalent duration. So when you get a rising spread, that means that lower credit quality borrowers are having to pay up to borrow money. That is usually a sign of economic weakness. That is usually a sign of stress in credit markets. Nothing weakens the US economy faster or more than credit crisis or a credit crunch or some sort of problem in credit markets. The flow of capital is extremely important in modern financial systems. And what you're looking at here specifically is this is daily data back to December 2022. The dark blue line is the actual spread, and then those orange columns below are the 20 trading day change in high yield spreads. Now that just shows how much they rose or fell over the past 20 trading days. That's roughly a month. What really got my attention on Friday is that over the last 20 trading days, high yield bond spreads are now up 102 basis points. That's 1.02% over where they were a month ago. That's a very rapid rise. In fact, that's the largest rise we've seen in the spread on this basis since early 2023 amid the regional banking mini crisis. Now you can see, look at the absolute level, that's the line on the chart, the blue line on the chart, and we're back at about 4%. which is the highest we've seen since late 2023. Now, I would say, a month ago, I looked at this, I wrote about it in Smart Bonds. I think I might have mentioned in a video, don't hold me to that though, that, the credit spreads were still pretty well behaved a month ago. And you can look at this chart and see, back in early March, they'd risen a little bit from the lows, but those are historic lows for the spread, historically sort of wide open credit market, and they'd only risen a little bit. Now it's become much more severe. They've risen from around 2.5% to 4% in the space of just literally a little over a month on that basis. So that is a concern to see a rapid jump in credit spreads. Let's compare that to some historical examples for reference, right? Same chart, weekly basis this time, and this is from February 1997 all the way up through February of 2003. Now this is a period that encompassed the tail end of the 1990s bull market in the stock market, economic boom, the 2001 recession, of course, the terrorist attacks on 9/11, 2001, and also part of the recovery for the stock market and the economy starting in late 2002, early 2003. And what you can see here, again, high yield spreads jumped in the summer of 1998. That was around Russia's debt default, is what was going on there. Then they kind of calmed down until 2000, and then we began to see a steady rise higher. So the way credit spreads generally move is you'll see spikes, then kind of like a period of calm. You even see sometimes junk bonds or high yield bonds rally a little bit, and then you'll see another sort of leg higher, etc. Right? And that's exactly what we saw there in 2000. We saw a big spike up and through the stock market peak in March of 2000, kind of traded sideways with a slight upward drift over the summer, and then another big surge late in 2000 into early 2001, and the recession started in March 2001. So the lesson here, I think, is twofold. First of all, pay attention when you see a surge in credit spreads. It doesn't always mean a recession is imminent. For example, 1998, there was no recession. However, if you see credit spreads rise and then kind of remain elevated and then see another leg higher, this is typically what you tend to see ahead of a major economic downturn or a recession. And we haven't seen that yet. I would say we've seen sort of an initial spike. I wouldn't be surprised to see it kind of consolidate or even see high yield bonds rally, as I'll talk about here in a little minute, a little more. But if we continue to see it sort of generally trend higher as we approach the summer months, that's going to be a very bad sign. Definitely something to watch. Now let's look at, on a weekly basis, the current situation. So make it easier to compare to that late 90s, early 2000s cycle. Again, what you can see here, I took this from 2020 all the way up to the present time. This is, again, weekly basis. And what you're looking at, those columns on the bottom, those orange columns on the bottom, are the 4-week change in credit spreads, which is also about a month. And what you can see here is, credit spreads peaked in July 2022, right? A couple of months later, the stock market bottomed. We didn't get a recession that cycle, but the stock market bottomed in October of 2022. Then we saw a general trend lower in credit spreads throughout the entire bull market for the S&P 500. And now, of course, we're seeing a renewed surge. These things are correlated. When you see credit spreads generally rising, that suggests weakness for the equity market as well, and also suggests that you really don't want to hold a lot of high yield debt exposure or bond exposure. It's also, as I said, a series of higher highs and higher lows is a negative for the economy, negative read-through to the economy. The opposite, a series of lower highs and lower lows, is a positive read-through for the economy. And I think what we're seeing right now is a potential problem. You're seeing a spike here. Again, very important what happens over the next week or two. Do we see high yield credit spreads come back down? Is this a short-lived panic? Or do they remain kind of elevated around that 4% region and then start to trend higher as we move into the summer? That's what I'm watching, as well as the soft data. And as I said, I do think there's a high risk that at some point over the next 6 months or so, we begin to see a handoff from that soft economic data, or softer economic data, to the softer hard economic data, Other indicators like credit spreads that I watch very closely in the smart bond service and really across all the research that I do. I would say, just in summation, recession risk is nonlinear. And what I mean by that is that normally the risk of recession is relatively low. Since 1945, over the last 80 years, the US economy has only been in recession about 13.5% of the time, okay? So usually the US economy is not in recession. So in any given time, recession risks are low. But you do tend to see probability rise very quickly. So it goes from sort of 10 to 15% probability of recession over the next year to 50% very quickly. And I think that's where we are today. I would peg the probability of recession over the next 12 months for the US economy at around 50-50. And that is elevated. Doesn't mean we will see a recession. All this could change in the next 4 to 8 weeks. But I've seen enough deterioration in the soft economic data, credit spreads, other indicators I watch to warrant at least saying there's a high probability or higher probability or rising probability of an economic downturn. And I believe that means that you need to take action in your portfolio. You need to take action in your stock portfolio, of course. But what I want to really talk about today is the bond market and some of the things we're doing in smart bonds to actually take advantage of this situation. We've actually been doing this for some time now. Last summer, in the summer of 2024, I actually began talking about and eventually adding to our duration exposure in the model portfolio. Now, what that means is that I started recommending more intermediate and long-term US government bonds. These are bonds that tend to be sensitive to interest rates. So in other words, when interest rates decline, these bonds rise more in value. We continued with that. In that same thread, we also began to lower our exposure to some areas of the credit markets and the bond markets and the preferred markets that are more vulnerable to economic weakness, the economic cycle. So examples include, we sold off one of our CLO recommendations, collateralized loan obligation recommendations, last summer on the view that the economy was looking a little shakier, or at least in the latter stages of an economic cycle. We've continued with that general move since. So earlier back in early March, over the last month especially, back in early March, we added more to our long duration exposure. And again, more sensitivity to lower rates, higher prices. That turned out to be a very good move as bonds have rallied. When we did that, the 10-year Treasury was around 4.25, 4.3%, and today it's under 4%. I actually think that if we do see a recession, I would say that you're more likely to see a sub-3 yield on the 10-year than anything over 4.5% again this year. So we continue to add to our duration, both with those longer bonds, also some intermediate term Treasuries, right? As well as some intermediate term, high grade, investment grade corporate bonds. The other thing we did in the middle of March is we started adding to some of our overseas bond, international bond exposure. So international developed market government bonds, some international emerging market government bonds, as well as some international corporate bonds. Now, the reason we did this is twofold. One, these bond markets tend to perform well when rates are falling. And in fact, they have performed very well and outperformed the broader US bond market since we recommended them back in the middle of March. Also, as I'll show you here in a second, we've seen a lot of weakness in the US dollar, which will benefit some of these international bond funds. Now, you have to be careful. There are some ETFs out there, some exchange traded funds out there that buy international bonds, but they also hedge the currency risk. So that doesn't give you any benefit from a weaker dollar. We have one fund like that, but we also added a lot of exposure to local currency bond ETFs. So these are bond ETFs that buy foreign government bonds or foreign corporate bonds in the local currency and do not hedge their currency exposure. So you get sort of a double bite of the cake, if you will, right? You get first the benefit from lower yields rising bond prices, bond market acting as a safe haven, and you get a second benefit from a weaker US dollar. The most recent recommendations that we have made, I actually put out an alert on Friday, that would be April the 4th, right? Buying some inflation-protected bond exposure. Now, I'll throw up a slide here real quickly. We already had some TIPS exposure, Treasury inflation-protected securities exposure in the portfolio as of the beginning of this year. We added those back in last May, actually. And they have done very, very well. Very well compared to the stock market and also the broader bond market, especially recently. In particular, we have that blue line on the chart here is the BND ETF. That's a Vanguard ETF that tracks the broader US bond market. I don't recommend that one. I'm just putting it up there for reference. There's also an ETF out there called the iShare TIPS ETF. Symbol there is TIP, TIP. And I pictured that in red on this chart. That I don't recommend that one either, but that is one that is widely followed. It's the largest bond TIPS ETF. Now, for those of you who aren't aware of TIPS, TIPS are US government bonds, right, that adjust the principal for inflation. And it's based off the headline CPI index. So in other words, if inflation is high, those bonds compensate you as a bondholder for that high inflation, right? So TIPS are a great thing to buy when you think that interest rates might be flat to down, but inflation is actually going to remain elevated, which is pretty much what I think is going to happen this year. The Fed may talk tough sometimes now, but the first sign of economic weakness, like we saw last summer, they cut rates. Regardless of what happens with inflation, you can actually see it teed up in the press conference following the Fed's meeting back on March 19th, where he talks about, well, we are inclined to maybe look at any inflation from tariffs as transitory or temporary. So at any rate, these bond funds have performed well for us. We have an intermediate term TIPS ETF, which is that green line. That's done quite well. And then we have a short term TIPS ETF, which is that purple line, which as you can see is up almost 4% year to date in 2025. Again, against the stock market that's down 13.5%. So TIPS are another area to look at. These that I have on this slide we've recommended for some time, but what we added on Friday is actually an international TIPS ETF. So this buys, the US government is not the only entity to issue inflation-protected bonds. The United Kingdom has done it for far longer than the US has. Germany has such bonds. Even some emerging markets like Brazil have inflation-protected bonds. So this ETF buys bonds from inflation-protected bonds from all these countries. About 2/3 of it is developed countries, and about 1/3 is emerging markets. So we added that new recommendation on Friday. As I said, that benefits from three things really, right? Lower rates, higher inflation. So if we're in an inflationary market, TIPS are a great thing to own. And of course the weaker dollar, because those bonds in that inflation-protected security, international inflation-protected securities ETF are local currency bonds. So they're denominated in euros, British pounds, Brazilian reals, etc., Canadian dollars. So the last slide I want to throw up, I promised you I would, so I do. This is a chart of the US dollar index. And you can see that the US dollar index tried to break higher in mid-January, but really failed. And we've pulled back now to that sort of long-term support level around 100. I suspect that you will see the dollar index weaken below 100. And when that happens, I think it could get ugly for the dollar very quickly. And that speaks to having a considerable portion of your portfolio in international markets. And in the bond market particularly, you can get a lot of the benefit of foreign currency exposure without all the risk of, say, buying a foreign stock. Now, foreign stock markets have outperformed the US year to date, but of course they are volatile compared to the bond market. And, right, it's hard to imagine that if the US economy goes into recession, that all your European markets, Japanese market, all these markets are going to break out to multi-year highs, week after week, as they did earlier this year, with the U.S. economy in recession, the U.S. markets in a bear market. So I think there are opportunities outside the U.S. in the stock market. I think that there will be options to buy particular areas of those markets on the equity side. But what I really like is the bond market for those international markets, because you're getting the benefit of the weaker U.S. dollar. You're getting some of the benefit of the growth from places like Brazil, but you're also getting sort of the stability and yield inherent in the bond market. So that's what I'm looking at right now. That's sort of a basic 30,000 foot rundown of my outlook for the economy and markets. If you're interested in the Smart Bond service, we are offering a risk-free trial to the service. Sign up today for any of our subscription options. Test drive the service for the next couple of months, see our model portfolios, get all the updates and issues. And if it's not for you for any reason, then simply call us or email us and cancel your membership for a full refund. I guarantee it. So if you'd like to give it a try, I think this is an ideal time to do so. And in fact, I would say that this is the type of market environment, the stage of the cycle, if you will, where bonds really shine. Not only are we earning an average yield of 5% on the bond ETFs in the Smart Bonds portfolio, we only recommend exchange traded funds, things you can buy through your normal stockbroker. We're not recommending individual bonds or mutual funds. These are all exchange traded funds. Average yield on them is somewhere around 5%, a little over 5% right now. So that's very attractive in a market like this. Obviously, they act as a safe haven during market storms. And there are so many new ETFs listed over the last 5 to 7 years, tracking all these different niches of the bond, credit, and preferred stock markets. You can play a lot more trends using just ETFs on these markets than you could 5 or 6 years ago. So I think it's an ideal time to look at the bond market, consider the safety and stability of this market in tumultuous times like this. We've already kind of proven that with our bond portfolios up this year when the stock market's just getting hammered. So hope some of you will give it a try. I hope you found this useful. Thanks for listening. Again, my name's Elliot Gu. I'm the editor and publisher of Smart Bonds. Thanks for listening.